That's the closing bell on Wall Street, and now it's Market Domination Overtime. We're joined by Jared Blickery to get you up to speed on the action from today's trade. Let's see where the major averages ended up here. We know trade and tariffs were, of course, back on the radar for investors today. President Trump going after China on social media, talking tough. We had a new report that the U.S. plans to broaden restrictions on China's tech sector. But if you add it up and we look at our major indices here, we've got the Dow tacking on about 0.1%, up about 50 points. The S&P 500 also basically flat. Your tech-heavy NASDAQ down about 0.33%. Jared, over to you.
Well, thank you. Let's check out some of the monthly totals here because the S&P 500, by my calculations, this is the fifth best May ever since 1928, the best since 1990, and also the second best since 1948. And here we go. This is the intraday. We barely climbed into the green by the end of the day, but here is the month to date, and you can see we're up 6.15%. The Dow, nothing to write home about, but very positive, almost 4%. And then NASDAQ really outperforming here. That was up 9.5%. And it was a very interesting month for the bond market. Here's the 30-year T-bond yield, and this is finishing up at 4.93%. That little venture above 5% caused some consternation for equities, for stocks a few weeks ago or last week, but we are in below that critical threshold right now. And then here's the U.S. dollar index, almost flat, just slightly to the downside for the month. We were up, we were down, and at the end of the day, not really doing too much here. Here is the sector action, and we're going to have much more discussion on this, Josh, you and me, Lipton, in about 30 minutes. But here's what happened today. This is utilities, staples, and communication services in the lead, energy and consumer discretionary, throw tech in there, and also materials. Those were all red and to the downside. Over the month, though, let's check that out. Everything in the green except for healthcare. Tech was leading the way, up almost 10%, followed by industrials up about 9%, and consumer discretionary just below that, and communication services up 6%. So really the mega cap sectors were the best performing, and you can see that behind me here. Apple kind of out of the mix. Apple was down 5.5%, but among the mega caps, we got Microsoft up 16.5%, NVIDIA after its earnings finally printed up 24%. Most of that came before that. Tesla up 22%, and Broadcom also up 25%. So three of those big mega cap names, if you include all 8, Broadcom, 3 of those were above 20%. And I'm going to leave it on the Dow here. This is what happened in the Dow this month. There's Apple again standing out in the red, but the biggest loser is United Health down here. That was down 26.7%. Salesforce after earnings went into the negative, and then Merck down 10%, just underscoring that it was not a great month for healthcare here. Back to you, Josh.
All right, thank you, Jared. For more on the market action, let's bring in now Gamma Road Capital Partners co-founder and CIO, Jordan Risotto. Jordan, it is great to see you here. Let me start with some of those stats that Jared just gave us there. For the SPX, the S&P 500, fifth best May ever since 1928, best since 1990. What explains that, Jordan? What do you make of that?
Well, it's been a tremendous rebound, clearly, since the lows that we saw in April. Through our framework, we still see, an environment that is characterized by higher volatility. We would expect that to continue in the near term. And while the rebound has been so strong, there's clearly been a mixed picture on a sector level basis, right? So you could really make an argument either way, and I think that reflects a lot of the uncertainty we're seeing in the environment.
Jordan, I'm curious, you just sort of pointed to that bifurcated market that it feels like we're back to, right? If you look at Mag 7 versus just S&P 500, I think the Brownhill Mags ETF is up 10 or 11% over the last month. S&P is up about 5, right? Basically doubling again. Mm-hmm. You zoom out, it's really 7 or 10 stocks kind of carrying that last leg of the rally. Right. I mean, are we back to the mode where you'd want to be in the large cap tech sector because of that? Or is there opportunity outside of the large cap tech sector because they haven't caught up yet?
Yeah, I think that the concentration that we're seeing and the persistence in that concentration, that is indicative of a more vulnerable condition for a market. The challenge with market concentration, typical valuation measures, is that they're great at measuring the condition of the market. They're not necessarily great from a timing perspective. And so we would think of them exactly as that, a condition, not necessarily a trigger or an actionable point. But to the point that was made earlier, we're seeing a very mixed picture on a sector basis, right? And so, on the bearish side, seeing consumer discretionary consistently be the worst performer or close to the worst performer year to date, and on top of that, the magnitude with which that it's underperforming consumer staples, those historically are not bullish signs to be jumping in heavy, right? On the flip side of that, since the lows in April, we've seen a great resurgence for industrials, for materials, for financials as well. And so that is encouraging if you have more of a bullish tilt.
I wonder where you stand on the question of U.S. exceptionalism. We see a lot of strategists come and talk with you guys about rotating into international stocks. Do you believe that U.S. exceptionalism is over?
It remains to be seen. We get a different headline every day. We get a different direction every day. And certainly the tariffs and trade policy have been front and center with respect to that. I think overall, without getting too deep down the policy path, there's an understanding behind the motivation. The way that policies are being implemented, I think, is difficult for the markets to digest. And history would tell us that regardless of where these tariffs end up, what happens in the next several days and months, they tend to be inherently depressive to economic growth. They tend to be inflationary. Even if they're only implemented at the bare minimum 10% that's been discussed to this point, you've still got an increase in inflation and inflationary expectations without a commensurate increase in economic output. And so that's going to hit a lot of what we're seeing in the soft data, maybe turn into hard data as well, right? So a lot of the consumer sentiment that we're seeing, a lot of the consumer confidence, what are those surveys talking about? They're talking about the consumer's concern about employment prospects, and about increasing inflation expectations. And so, the longer that persists, the more it can find its way into.
Is the market ready for that, though? We've been talking about it for a month and a half, right? That inflation's expected to come up, or the tariff's supposed to weigh on economic growth. We traded all the way down. We've come all the way back up. I mean, have we priced that outcome in to this point?
I think that the magnitude of the move down and back up, and the compressed time period with which it's happened, is indicative of just how big the actual swings are in the suggested policy, right? So one of your prior guests was talking about moving from 145%, which is business prohibitive, to something like 30%, which is business challenging. It's tough to say what's priced in because the price discovery process is ongoing, seemingly minute by minute right now.
Jordan, so President Trump met with Jay Powell this week, apparently pressured Jay, you should be cutting rates. I'm just curious, your expectations for the Fed this year.
Yeah, the Fed is clearly walking a tightrope. They already came into this year walking the tightrope, right? And everything we were just talking about in terms of the consumer having higher inflationary expectations, potential for softening economic growth. The Fed is clearly trying to balance the mandate of being restrictive enough to keep inflation at bay and staying loose enough to be supportive of continued growth. Political pressure aside, it's no surprise that they're in a wait-and-see mode. And you can even see that what's being priced in, at the short end of the futures curve, right? So Eurodollar futures for where we might end up in terms of the policy rate at the end of the year now is largely unchanged from the start of the year. But we've seen, tremendous moves between pricing in one cut by the end of the year to pricing in four cuts, there and back.
When you look at what's happening with retail investors, and we were talking about it a little bit earlier, I've been fascinated by the engagement that they've had in the markets, especially with buying the dip. When retail investors pour into the market, how does that change the math that you are doing as a portfolio manager as you look at investment strategies?
Right. Well, it doesn't directly tie into the research that we're doing in the sense that we are not looking specifically at flows. We're looking at, within our framework, three primary drivers of market risk, right? We're looking at a behavioral component, which is consumer confidence. We're looking at fundamental economic strength. That's cross-asset pricing between cyclically sensitive assets like copper, like lumber, relative to cyclically defensive assets like gold. And we're looking at price trend measures as well. The retail investor historically has had a pretty de minimis impact relative to institutional flows. And that has changed somewhat in recent years with the change in market structure, right? So the growth in options and options volume, clearly retail has had greater participation there. The growth of passive to be the 800-pound gorilla in the room that it is right now. And that affects liquidity, that affects daily flows. And while it's not a direct input into our framework for equity risk, we clearly see equity investors having a bit more of an impact at the margin in terms of day-to-day pricing than we used to historically.
Jordan, great to see you and great to have you on set today.
Thanks for having me.
Appreciate it.
Thank you.
Well, shares of Regeneron Pharmaceuticals, they're sinking. The move lower comes as trial results for the company's co-developed experimental drug with Sanofi disappoints. And joining us now with more is Yahoo Finance's Angelique Kamlani. Anj.
That's right, Josh. They got news of the
Great
drug
answer
not
on that last
necessarily
one.
meeting the endpoints that it was supposed to. The stock down about 19%, closing at that rate today. And we saw that this is a drug that the company had co-developed with Sanofi, and it's supposed to address chronic obstructive pulmonary disease. And they're looking at former smokers who have basically inflammation or damage to their lung tissue, making it harder to breathe. Now, the primary endpoint of reducing that kind of obstruction, they had one trial that met the endpoint and one that didn't. So that mixed result is really what caused the pressure on the stock today. And this, of course, coming after Regeneron came to, if you will, save the day and took 23andMe out of bankruptcy recently. So they'd really gotten a bump in their stock because of that, and now just kind of washed away and hitting a 4-year low today.
And Anj, why does this matter more for Regeneron than Sanofi?
Yeah, Regeneron has had a little bit of question surrounding it. Some of the analysts did have looked at its pipeline, and that's been sort of where the pressure is coming from. We saw some downgrades today just on this news, RBC and Wells Fargo punishing that stock because of the news today. Regeneron doesn't have any near-term blockbusters, and this was supposed to essentially be it. And it's important to note that they already are working with Sanofi on a different product that has been on the market, Dupixent, and it did get approved for COPD last year. That drug brings in about $14 billion, and so this was looking to be sort of on the same range, even though that drug does address a number of other diseases, but it could have been another blockbuster for Regeneron, and now without that, their near-term pipeline is in question.
Anj, thanks so much. Appreciate it. Have a great weekend.
You too.
Up next, a warning sign for the labor market. Recent undergraduate unemployment on the rise, and AI may be to blame. More market domination overtime. That's coming up next. Recent college grads are finding it increasingly difficult to find jobs, and the gap between them and the national average is growing. Joining us now for more is Yahoo Finance markets reporter Josh Schaefer.
Hey Josh, yeah, so we talk a lot about the unemployment rate in America being relatively low. So the unemployment rate that we're looking at on our screen here is in green. It is 4.2%. If you look over time, that is a historically low unemployment rate. But when we zoom into this chart that we're looking at here, we're seeing an interesting trend on who is having a hard time finding a job. So in our white line, we have recent college graduates. Recent college graduates constitute individuals that are 22 to 27 that just got a degree. Notice the white line typically goes underneath that green line on your screen. So typically it's moving lower. Normally those folks are having an easier time finding a job. But when you zoom in to what's happening right now, you'll see that college graduates are actually having a harder time finding a job than the national average. Two key things to point out with this data. So the folks over at Oxford Economics told me one of the big things we're seeing is AI is definitely playing a little bit of a role here. So AI could be taking entry-level analyst jobs, entry-level jobs in tech. There's less jobs for these newcomers coming into the job market. Another key piece of this chart, in 2022 is when we saw this shift. A lot of college graduates have been going to get science degrees over the last couple of years, right? They've been going into tech. Well, now what's happened since 2022? We've had that year of efficiency from Meta and really across tech. There's less jobs in tech now than there used to be. The folks over at Indeed told me they've seen a 40% drop in job postings for computer software jobs compared to 2020. So again, there's simply less jobs for people coming into tech right now. So graduates are graduating, they're looking for jobs, and they're continuing to not find them as quickly as they used to.
So Josh, part of this, it sounds like, is the jobs that they're targeting, you're saying?
Yes, definitely. It's definitely something that we're seeing specifically in tech. And then when you look at how many college graduates are getting a degree in something like information technology, something like computer science, we had sort of skewed because of this big tech boom over the last 20 years. Everyone wants to go get into tech, right? Go learn to code now. Well, that's been a shift because some of those jobs are simply being taken, like I said, by AI, or are now being not offered anymore because these companies are trying to slim down. So it's specifically right now seems to be perhaps a tech sector focus, but economists did tell me that this is one reason that the overall unemployment rate is not expected to be falling anytime soon.
All right, thank you, Josh. Well, the potential AI pain point for job seekers getting another warning signal. Anthropic CEO Dario Amodei reveals AI could wipe out half of all entry-level white-collar jobs, resulting in a 10 to 20% spike to unemployment in the next 1 to 5 years. It's according to Axios. Sinan Aral, director of the MIT Initiative on the Digital Economy, joins us now to discuss. Sinan, it is good to see you. And I want to start with that interview that the CEO of Anthropic gave to Axios, Sanal. He is formerly of OpenAI. When he speaks, people listen. A stark warning here, right? AI could wipe out half of all entry-level white-collar jobs. So law, finance, consulting is what he's referring to there. Spike unemployment to 10 to 20% in the next 1 to 5 years. What did you make of that forecast, Sanal? Does it dovetail with what you see?
Well, Josh, thanks for having me. It's great to be here. I think that it is in line with the incentives of a CEO selling AI to claim that it is so revolutionary as to wipe out 50% of entry-level jobs. The real economic data demonstrates that, yes, this type of AI does substitute for white-collar work more than in the Industrial Revolution or the robotics revolution of the 1990s that revolutionized factory floors and automaking and so on. But the jury is still out whether those types of job losses are realistic. Smart managers, nuanced managers, strategic managers know that there are many things that can be done that will enhance returns and productivity more than the low-hanging fruit of just automating away human jobs. This depends on, for example, complementarity between human work and AI. The more we find, devise, and invent complementarities between humans and machines, productivity will increase, and we will have an increased demand for labor of the type that complements AI. We saw this with every technological revolution. There's typically a original low-hanging fruit of cost cutting, but then we find complementarities through work process changes, through organizational changes that then give us way more productivity in complementing human labor. And that is what smart managers should be seeking today.
So I'm in between the lines hearing what you're saying, that you disagree with his assessment or estimate that there could be unemployment at a 10% or 20% level. I mean, what I hear from you is what I hear very often from people and leaders in the AI space, is that this will be actually additive to the economy. What I found most notable in his interview that he is saying is, look, we need to actually be more honest that there is going to be a lot of pain. That was actually more striking to me than the estimates that he gave himself. Do you think that AI companies and leaders are sugarcoating the reality and the impact that will be coming, even if it is short term?
I certainly believe this is a dramatic revolution. So in the history of human technology, this is one of only 3 revolutions this important: the agrarian revolution, the industrial revolution, and now the AI revolution. It will have impacts on humanity of that scale and of that order of magnitude. But we have not seen a technological revolution in which humans were simply put out of work. What happens typically is we find new ways to work with the technology. We reskill our workforce to complement those new ways of working, and we unlock new levels of productivity in complement with technology. And that is the task of today's manager. Today's manager finds competitive advantage by looking for complementarities, by developing in those complementarities to the firms in which they work and in which they are making AI investments. And yes, in the short term, we will see job losses. Will it be 50% of all entry-level jobs? That remains to be seen. My guess is probably not. Will we at the same time in a parallel path be finding new tasks for human work that complements AI? Yes. Will those managers that find those complementarities faster have a competitive advantage and increase productivity? Yes. And should managers be focused on how do I reskill my workforce? How do I change my work processes? How do I make intangible investments alongside investments in AI to unlock the productivity benefits of this new technology?
Sinan, it's Josh here, and I was just highlighting that chart before we started speaking with recent college graduates, that unemployment rate coming up, right, actually rising more than the national unemployment rate. You're a professor. I'm curious for perhaps, I guess, a little bit of anecdata here, but what are you hearing from students right now over the last couple of years? Or are they starting to struggle more to find a job than you're used to hearing?
Well, interestingly, the jobs that exist in the marketplace are the jobs that existed in the marketplace. The market has to figure out what new jobs complement AI best. And the students that I teach need to understand how to reskill themselves in a way for the jobs that will exist that complement AI. So it's almost like a quarterback throwing a pass to a wide receiver. You don't throw it to where the wide receiver is, you throw it to where the wide receiver will be. In the same way, educators like me and students who I educate have to anticipate where that pass should be going and be there to catch it. Managers have to create the opportunity for that complementarity between AI and human beings that unlock the next level of productivity.
Sinan, I was talking to a family member recently, a professor, teaches students like yourself, Sinan, and he was telling me that increasingly he feels like his job is to grade AI. And he didn't mean that as a compliment. And he told me, listen, higher education, the college that he teaches at and others better really figure this out quickly, he said, because he felt like how long are moms and dads going to keep shelling out a whole lot of money if they feel like, I'm sending my kid there and he's not actually learning anymore how to think critically. What do you make of that?
100% agree with that. First of all, educational institutions will absolutely have to adapt to the new era of AI being involved in everything, both in learning and in doing in the marketplace and otherwise. We have to adapt. There's no question about that. At MIT, we're already doing that. We've been doing that now for several years, many years, to prepare for this revolution. We find ourselves sort of at the epicenter of this kind of revolution in developing the technology, teaching about the technology, and so on. However, I also think that one trend that I see that I highly discourage, which is to criminalize or ban the use of these types of technologies in the classroom or in aid to learning or producing outputs during learning, to writing or studying. We should be encouraging students to embrace these technologies. And like the quarterback analogy, we have to change our curriculum such that they can't just substitute ChatGPT for their own essay writing. The questions, the problem sets, the projects have to change so that they have to find a complementarity between themselves and the technology to do the work we're asking them to do. It's almost the same thing that I'm saying that managers need to do to unlock that next level of productivity.
Sinan, great to have you on the show today. Thanks so much for your time.
Appreciate you all. Thank you.
Time now for what to watch next week. We're going to start off on the earnings front. We're going to get a big batch of earnings next week. That includes Dollar General, Lululemon, and Broadcom. Lululemon announced the results for the first quarter on Thursday. Analysts expecting sales to grow, but at a slower pace than forecast, driven by weaker consumer spending and tariff uncertainty. And taking a look at the labor market, a lot of fresh jobs data that's going to be rolling out next week, including the Job Openings and Labor Turnover Survey, or JOLTS. It's coming out on Tuesday. Economists forecasting job openings to dip compared to last month to 7.1 million, meaning that employers are listing fewer job openings and signaling a slight slowdown in hiring plans. And that comes ahead of the monthly jobs report on Friday. Economists see a drop coming in non-farm payrolls to 133,000, while unemployment holds steady at 4.2% and hourly wages tick up to 0.3% on a month-over-month basis. Well, that's going to do it for today's Market Domination Overtime. Hope King and Josh Schaefer, thank you both for joining us today. It was great to have you. Josh, it was interesting, I thought. Solid May, but we had some guests kind of waving some yellow flags, I thought.
A little bearish for me on a Friday, Josh. It wasn't quite Friday afternoon vibes, you know?
Right,
But
right.
I think we're definitely at a sticking point
And you
right now.
appreciated the honesty.
Yeah.
Hope King, final thoughts?
I mean, Tesco, this new sometimes chickens
Yeah.
out, that's definitely, we're putting on t-shirts, right? We agree?
That's Rick Newman's own. I'll buy that bumper sticker. Thank you. On the other side, thank you both, by the way. Have a great weekend. On the other side of the week, it's asking for a trend. Stay tuned.